Hello, everybody. Welcome to week 44 of 2025. This is the Build Weekly Roundup. As always, you've got myself, Cameron Otsuka, and you've got Matt Dines. We've got three topics to go through. Again, kind of following off of last week, a lot of news going on, a lot of articles coming out, a lot of headlines to talk through. But number one is really the Federal Reserve did cut rates. Matt will go through kind of explaining what that means. They also at the same time announced the end of quantitative tightening, so it'll be interesting to see what that means. So Matt, I'm interested to hear what you say there. And then secondarily, uh, a meeting between Trump and Xi. This is really important. There's been a lot going on in terms of Chinese and U.S. Trade diplomacy, let's call it. And this is going to be another kind of one of those critical points for where we go from here. And then finally, there's a hurricane going on in the Caribbean, which has already devastated a large part of, I believe it was Jamaica. Um, we're going to definitely talk
Mm.
about what that means in the broader picture as well. But just wanted to point out that there's a lot of humanitarian issues that need to go on following on the hurricane. So again, three topics for today. As always, let's go ahead and jump right into it. Matt, let's start with the Fed, the hawkish cut. Walk us through kind of what this means in your mind, and also kind of broader picture where we're going from here.
Yeah, you know, props to Cameron and I for coming up with some funny images, I think, every week. Really thanks to Perplexity and Grok to deliver for us. But yeah, the hawkish
Easy
cut,
peasy.
right, is number one on the three-part panel. We got another ridiculous one with Trump and Xi. The 12 is, in reference to Trump calling it in the media a 12 out of 10, just in typical Trump marketing hyperbole. Xi called it warm, which is, I guess, the best we're going to get from him. We'll talk about that one in a second. But on to our hawkish falconer, Jerome Powell. So we got yesterday the Fed's decision. They're going to cut rates 25 bips as expected. It's another one, second one of this kind of I'd call phase two of easing in the long-term cutting cycle, right? Beginning in September 2024, took a pause. Now we're back on again. The one we didn't get or didn't know that we were going to get for sure ahead of this was the end of QT. So QT is the balance sheet runoff, basically the Fed's holdings of treasuries, mortgage-backed securities, agency debt. Those as they mature, instead of just kind of vanishing into monetary ether, they're going to start recycling those proceeds of principal maturity and interest payments into treasury bills. So this was the net new, but the market didn't know that they were going to get. And the other piece of guidance that trading desks, who are involved in, just moving markets in U.S. Treasury debt and foreign exchange. The other piece of the puzzle that they got yesterday that they didn't have before, which is really the information, right? That's what prices are reacting to, was Powell's kind of hedging of his statements to say, hey, don't just assume another rate cut at the next meeting in December is a foregone conclusion. He mentioned that there may not be board consensus at this point for that next cut to happen. Could still materialize. We'll see. There's a lot that will shake it out between where we stand today at the end of October and when that next meeting is, middle of December. But we're on kind of a 6 to 8 week, just kind of steady as she goes type of course. We're going to follow the existing trends. The other piece that was kind of an unknown to market trading desks was how that QT would cease. Right, it's got part of the announcements was this will QT will officially come to an end on December 1. And what's going to happen is, we knew that what it means with QT is the runoff will eventually be redeployed into other credit assets. What we got on yesterday's announcement, this is kind of a sister publication from the Federal Reserve Bank of New York, which is actually like where the FOMC conducts its policy, right? It integrates with the financial markets, with the capital markets in New York. The the seat of the global dollar hub, right, or the main seat. Federal Reserve Bank of New York is going to take those principal maturities and interest payments as they come in, and the Treasury debt they're going to roll over into, they mentioned it's going to be Treasury bills, and they're going to skew. It's going to be about 75% hitting into 1 to 3 month maturities, and then the other 25% is going to be the 4 to 12 month. So what this is primarily going to do, this is just kind of old school Alan Greenspan monetary policy. Fed is going to come in as a non-competitive bid, which is going to pressure front ends down, right? More of that volume or more of that, yeah, repurchase volume coming in is going to hit the front end the first 3 months. That's going to force pressure on discount rates to come in the bills market. So from the normalization of the yield curve, that front end is the last bit that's remaining inverted at this point. What this policy is going to do is essentially squeeze that last bit out. The thing about Jerome Powell's statements that was kind of the surprise for markets to absorb was it's not going to come all at once. You're going to have to put this in a crude analogy. It's like pushing your kid into the deep end of the swimming pool and not coming in to rescue them right away. You're going to have to learn to swim, right? And granted, if there is an emergency, if it turns out the kid can't swim, FOMC is not going to let the child drown. They're going to hop in. They're going to save it as they did in other circumstances, say 2019, repo crisis, et cetera. They're not going to let it faceplant. But what they're saying is, we're like, show me something here. You're going to actually have to fight through this one and learn to swim. So that's what markets responded to yesterday. So on that announcement, the policy front, what happened? Dollar spiked, right? Because what it means is, from the offshore dollar standpoint, you're not just going to get a liquidity, rescue buoy or a life raft like thrown to you on a whim like you got in Q3, Q4 of 2019. It's not the same cycle. You're going to have to go fend for yourself. And that's why, from the offshore dollar standpoint and FX markets, DXY rallies, right? So you got dollar strength into this hawkish cut, right? To give it a really ridiculous, we call oxymoron. And then on treasuries, you actually saw interest rates up, right? Basically, like the entire curve raised in terms of level 8 to 10 bips. That's a big day in yield curve land. So you put those two things together, Fed easing, but a stronger dollar on the news, and then rates selling off. You juxtapose those two. It's kind of counterintuitive, but what it actually amounts to is furthering of this kind of offshore dollar squeeze that's funneling. Think about the dollar for the last 40, 50, 60 years, the post-World War II dollar that we've grown up with, what we've been used to, like the expansion of this offshore dollar. This is a continuation of the policy moves from the domestic U.S. standpoint to concentrate and bring the control over the dollar into the U.S. Regulatory system, but also banking systems control. So this is part of that bigger process we've been unwinding. Got one last slide to talk about this from swaps. This is complex to get across. I think I'll save this one for the
I was
future
gonna
to go
say I
over.
have a lot of questions on how you
It's
decipher this. So
We can try. I think I need to put together a lot of background here. This is going to take longer than the 30 minutes we're planning. But
let's do an episode where we dive into this. But
let me
yeah,
just
why don't you
try.
do like a high level maybe,
Yeah,
if you can?
let me try really quick. So swap spreads, like, what do you hear those? You're going to hear these on Doomer podcasts, everything. What's going on? Swap spreads are negative. This is terrible. The world is ending. Key thing to keep into account here, a couple things for background. Number one, in 2022, we effectively finished the transition. We ended LIBOR, and we brought the kind of marginal dollar funding in the global dollar system. We shifted the center of balance from London on a fake unsecured, interest rate, like overnight interest rate, moved it to New York, where it's now secured overnight financing. You've got actually treasury collateral um, posted, skin in the game, between active participants who are engaged in real economic activity, real financial trades, to set this overnight rate. So first, like to read this, you see in the kind of the dotted purplish blue line, that's the old swap spread on the LIBOR standard. And really what it shows, like at the end there, as things get volatile, what this is showing is the LIBOR market is effectively dead. Like it's still kind of there, nascent, but it's getting highly volatile. There's no dollar supply. If you're counting on that for your banking and financial funding, um, you you're operating with a counterparty whose source of dollars is just flat out not long for this world. What you want to do very quickly, if you get the writings on the wall, if you want to still operate on a dollar standard, for your reserves, financing, settling of trade, et cetera, you got to move to SOFR. And that's where you see all the volume going in terms of the dollar system for um, overnight funding, marginal, short-term funding, that type of thing. So the purple, like difference too, the difference between the purple blue line and where those swap spreads were. We'll get into what swap spreads are actually doing in a second. And the shaded red, but it's really the white line. That's the SOFR swap spread versus the blue line. You see it, the SOFR swap spread. Look at that area from, we get the laser pointer out, 2020, late 2020 to 2023. That's basically this transition point. SOFR swap spread is about 20 to 40 bips lower than the LIBOR swap spread. Now, what's actually happening here? What the swap is if you're a global money market or global money center bank, and you're engaged in, like, you're the key hub of dollar trade, right? This kind of coupler of going from fixed to floating rate is a key piece of either laying on or off duration risk or credit risk, right? So what the swap actually allows two bank counterparties to do is basically switch out of either they can take a payment stream that's variable, which is going to be indexed to your floating rate. And this is where, all right, on one chart, the white, we have SOFR as your floating rate. The blue purple is LIBOR. And then on the other leg, the fixed leg, you'll get a fixed interest rate payment, kind of like the Treasury coupon bonds, right? Your interest payment is fixed, but this is just another fixed rate that is determined really by the discount rates in market on the Treasury yield curve. So that key gap there is basically the yield, or like a premium, a spread between LIBOR and SOFR on these swaps. What we did, you see that white line actually just starts in late 2020. It's kind of an order of operations as the U.S. regulators and financial system pull in kind of like the marginal producer of dollar capacity in this global dollar system from the offshore banks towards the U.S. domestic, towards secured overnight financing, SOFR, right? Basically, the way I view this, right? All right, the difference between your swap rate, right, which is a fixed rate, right, and variable component, the SOFR rate or LIBOR, that's just a number that's set every day. The difference between your swap rate, like the fixed payment leg, and the U.S. Treasury is going to reflect basically the profit that a bank will need to generate for providing duration capacity into dollar balance sheet, like the dollar banking system.
So
Pause. Any
far, so
questions
far I'm
there? And
following. Yeah,
we're
I
going
think
into
you're
a
going
meaty
pretty deep here,
subject.
but yeah, so far
Okay.
I'm following.
Yeah. So what the negative swap rate is actually representing here, in my opinion, is well, one, that gap, like SOFR is actually putting a true market price on um, dollar financing or providing duration capacity into the dollar financial system. That's one thing, right? So now banks are actually being fairly compensated for taking on that balance sheet expansion and lending in into duration. That negative swap spread is actually kind of compensation if you think about it. So if you did this trade and say you're JP Morgan, if you had a counterparty who wanted to take the fixed leg or pay, sorry, if you're JP Morgan, you're sitting on a treasury, you have a counterparty who wants you to take fixed, they want to take floating, or they want to have SOFR risk. What you can do is, hey, buy the treasury, sell the fixed rate uh, as JP Morgan, and then you lock in that spread essentially. And what you've done is provided duration capacity into the banking system or into the treasury to lend with further duration. So it's really giving the banks a profit margin for taking on that risk of really expanding their balance sheet into funding the U.S. Treasury's kind of fiscal deficits through coupon issuance. And what you saw with this announcement yesterday is basically the Fed saying like, no, we're not gonna help you, banking system or U.S. Fiscal policy on funding your deficits by buying coupon bonds. We're gonna make you actually pay the banks the market rate for doing that. And then you saw the reaction from those banks with the trading yesterday. One was kind of a rush towards the U.S. dollar and FX markets, and then two was Treasury rates go up because um, when the Fed kind of passes the buck and says, no, you're going to have to make the private, for-profit banking sector fund this fiscal expansion or fiscal deficits. That's where you saw the corresponding rise in yields. So this is all pretty complicated stuff. We could go much deeper on a deep dive here, but that's effectively, in my kind of framework, what you saw in reaction to yesterday's FOMC kind of policy update with a big one, right? This is a shift. It's the end from QT towards a neutral, and eventually, once they start buying, which could come down the road, you could get to a QE. But the key thing I would stress here, I think everybody in markets and even private investors, retail investors, we're so used to, after COVID especially, we think there's just going to be some massive liquidity, injection coming from the Fed. I don't think it may eventually be coming, right? It could be a while, right? So this is where the Fed, you listen to other board of governors. Logan from Dallas put out a paper in September that really highlighted this need to basically let the SOFR markets, let these markets find their levels and work themselves out. All of this infrastructure that we've been describing, SOFR, the swaps market, all of that, treasury, primary dealers, everything involved. We've laid a lot of infrastructure in the last 3 to 4 years. There's also new tools kind of put in place, the SRF, Standing Repo Facility, built for emergency liquidity needs. My point here is, don't just assume we're going to get some massive big liquidity print QE on the first sign of stress. If anything, just given this sign, what we saw for the announcement of QT in December, the guidance, hey, don't assume, from Jerome Powell in his comments, don't assume that this 25 basis points cut is a foregone conclusion for December. Um, Basically, what they're telling the private markets is like, no, you're going to have to stretch this out, right? And what this actually amounts to is we could take this to the next thing with G2 meeting, Japan, et cetera. We've got a total shift in the dollar system that's been underway the last 5 to 10 years, and it's getting stronger and stronger, right? This is where the stories we talk about US integrating Argentina into its new what I call like its new global US-led coalition. You've got Japan coming on board this week. So there's a lot of positive imagery or photo ops that have been delivered with President Trump and the new Japanese PM Taikichi. Look at the image on the right. She gifted him Shinzo Abe, Trump's good friend, his putter and a golf bag signed by former Masters champion. Can't remember what's his name.
Tsuya, I'm blanking on his exact last name, but yeah.
Matsuya. Yeah, it's a golf bag signed, and so if you think about gift giving, right, it's really hard to give someone of wealth something that actually matters. But these are like Shinzo Abe's putter. These are like really good gifts. Like if you're just thinking about recipient and giver, like these have a lot of meaning to them. Um, so you've seen, same way we saw the US-Argentina kind of new coalition cemented with the election results last Sunday that we talked about, 3 days prior, predicting what would happen. Those closed. We're not going to talk too much on them here. Same thing, US and Japan. Now, on the left, you see Treasury Secretary Bessent in the last day or two in media. I don't know if he made the trip over to Japan and Southeast Asia for APEC coming up, or if he's speaking from Washington. But Bessent came out with comments urging um, the Japanese government to allow the Bank of Japan the policy space to fight inflation. What does that mean? Like this gets into the actual money markets here. We're talking about the new dollar framework. Let's call it that. But basically, uh, asking the Japanese politicians, right? These new friends, right? Who it's everybody's warm and fuzzy here in the honeymoon period, to allow short-term interest rates in Japan to rise to suppress inflation. We've got 41 months in a row now. I know we talk about Japan being in a deflationary trap. If you look at the Japanese CPI, it's been
Yeah.
at this 3 to 4% level above target for over 3 years now. They're still pegged to the old school BOJ policies, massive QE, uh, suppressed interest rates, et cetera. Bassoon is saying, hey, let that go, fight inflation, let your bond market go, let the yen strengthen. But then what does that also do for the U.S. Japan trade balance, right? You've got the U.S. running large trade deficits with Japan. That's been a structural feature since essentially World War II. Um, what Basent is asking for is to let the bond market normalize, allow the Japanese economy to, or the yen financial system to fight its inflation, but that'll actually work its way through the trade balance as well, making Japanese imports of U.S. exports more competitive, and it'll help out the U.S. Situation. So all of these things are very interconnected and related, but this is just kind of the big picture development, the happenings as they kind of progress from week by week. All right. So no real importance on this headline in particular, but Trump and Xi, talked about their meeting. I don't know how important it actually is. I think what, if anything, it's just symbolic of a detente.
I think it's yeah.
Maybe there's things behind closed doors agreed to, but the U.S.-China kind of relationship. This is not the final form. It's if anything a pause in escalating further for some period of time. But you heard Trump call it afterwards. It was a 12 out of 10. That was the greatest thing ever. Just typical Trump showmanship. She called it warm, which is kind of as good as you're going to get on that front. But in terms of everything going on, very very big happenings in the U.S. Foreign policy and international financial policy front taking shape in the last 3 to 4 days, or
last week and a
since we
half, I want to
last
say. Yeah.
updated you. Yep. Okay. So last one, I think we want to shift to the Caribbean, the situation there. So we know, if you've been following this story closely, there's been U.S. executing, targeted strikes on Venezuelan just trafficking speedboats. That's been essentially, what the U.S. is saying is, hey, we're policing this now. Drug trade, it's connected to financial trade. It's a big business. It's banked by somebody. It's not the U.S. banks. For them, the U.S. banks wouldn't take that risk because they know they're going to get hammered. This does impact the international banking scene. So someone's business franchise is being foreclosed upon. That's part of this activity in Venezuela. The other piece, I'll get to this in a second, is all about international trade routes and the Panama Canal. You've also seen in the last month or so, the buildup and positioning of U.S. naval assets around the Caribbean. And this week, as this time of year, comes to a surprise of no one, this is hurricane season, and it's hit or miss. But you know, more often than not, it seems someone in the Caribbean is in for a tough go wherever the unlucky winner on the roulette wheel, come whichever number comes up, in any given year. You're always just trying to dodge that terrible storm in this location of the world. But Hurricane Melissa, it is one of the largest hurricanes, I think, on record. I don't know exactly which, but got to Cat 5 status. Jamaica just
Some of
took
the
it
videos
all,
are
and now it's moving
just
into,
incredibly crazy. Just seeing the size of the
yeah,
hurricane, but also devastation coming out of it. I mean, it's wild.
yeah. So you had a lot going on here, a lot of moving pieces. U.S. aircraft carrier group, the Gerald Ford uh, Armada. I don't know what the right term is. Yeah, I'm not a naval expert. Maybe we'll have one on someday to give us a better download. But basically, the Ford Group is coming over from the Mediterranean. It's in process. The Ford Group wasn't there yet, but it will be arriving in the next week or two. You also just have a lot of movement. Now this turns into also an international kind of rescue mission or aid mission to help out Jamaica. Cuba will need help as well. TBD to what degree U.S. will be involved with that aid mission for Cuba, just given the long-term dissociation that's been in place since like the 1940s, 1950s. But Jamaica, for sure, is going to need a lot of U.S. Assistance and aid. Um, you know, my base case is it's coming. It kind of slows down a bit the Venezuela situation in terms of preparing the naval assets, but it actually, I think, counterintuitive, might actually lead to more um, build up in the region, because now you actually have some international cover for a reason to be building out more
Right.
logistics and supply lines, because it's international aid. You've got someone in deep and distressed need. Um, and if you've ever read anything about war, any engagement at the end of the day, it's just a logistics operation. It's like, do I get my supplies to where they need to be? Don't overextend your supply lines. Whichever side does a better job of that is ultimately gonna um, outlast and ultimately win one of these engagements. So you've got that taking place. Um, you've also got this interesting development with U.S. military officials signing NDAs tied to this Latin America Caribbean mission. So it's very under wraps, everything going on. This administration, this Department of War, is, I guess I'll use the word hellbent. Um, I don't think that's a curse word. But anyway, they're hellbent on making sure the information doesn't leak out. No talks to media, no information leakage, just making sure all the buttons are tied up, which really highlights kind of the level of importance and criticality of I guess, secrecy and cover. That's in play here. Everything going on in the Northern Caribbean. What's this all about? Let's just tie it up here. Um, Somewhat related. I mean, it's definitely related to fighting the drug cartels, stopping the inflow of fentanyl in the United States. That's definitely part of the objectives here. I don't know which one of these is primary or secondary, or if they're two primary, but the real primary, what matters here is access to the Panama Canal. So you've got talk about the Caribbean, right? Basically two bodies here. You got, what we used to call the Gulf of Mexico. It's the Gulf of America now, and that's their signal in that, right? It's all about shipping lanes. And basically what the U.S. is saying here, calling it the Gulf of America, it's like we have dominance of this body of water up here, the Gulf of America, basically everything around the southeastern coast of the United States, the Mexican kind of coastline towards the Atlantic side, and then this little stretch here where between Florida and Cuba to the north. That's kind of the naval or the maritime waters. We have kind of full control and preeminence. And then the hot ground, where we want to make sure preeminent U.S. naval preeminence is established, is really this Caribbean Sea here. So the island chain, you can start it at the tip of the Yucatan, starting at Cancun. Everybody's had, maybe a nice vacation there. You got an open water stretch, but then you get into this, this chain of islands between Cuba, very long. You get into the Haiti, Dominican Republic, down to Puerto Rico, and then you get the smaller island chain, which then connects towards Trinidad and Tobago, and then you get into the northern coast of South America. So establishing control and safety of trade routes in the Caribbean Sea is really, in my opinion, the core purpose of this exercise that's taking place. That is the number one in terms of long term, most critical objective. Really, what it amounts to is U.S. maintaining access to the Panama Canal, which is key. All your West Coast trade ports from, Port of Long Beach, Los Angeles, up to like San Francisco, and then the Pacific Northwest. You got Seattle, Tacoma, Portland, et cetera, on the Columbia River, all of that. The economic integration, like you have to have the Panama Canal over the long term for what we're talking about here, the next wave of build out of supply chains, and ultimately the American economy built on the Western Hemisphere. You've got to establish supremacy here in the Caribbean Sea. So think about this. We just inked this partnership, sealed in at the ballot box on Sunday with Argentina. Any trade with Argentina, right? You're not going to go around the bottom of South America through the Strait of Magellan. It's just way too risky of a shipping lane. Like you just don't do it. You don't want to count on that. Those ships from Argentina would probably be coming up through the Atlantic side, and then if they're going to North America, or Argentina to the West Coast, you got to traverse the Caribbean Sea through the Panama Canal. You can make it up to the Gulf of America into the Southeast United States, or like the Atlantic seaboard up to New York, avoiding that northern coast of South America, Venezuela, which is kind of like the most hostile, sovereign state towards U.S. interest right now in the Western Hemisphere. But this is what this little exercise in the Caribbean Sea is all about, in my opinion. It kind of pieces together, and the puzzle pieces connect with everything we've been talking about on prior episodes and iterations of the weekly roundup. So basically, what we got here is probably 2 to 3 weeks of wait and see, more build up, just more logistics support coming in play. And you're going to see a lot of it for Hurricane Melissa. If the U.S. does that, it'll be kind of positive for international relationships, and then that'll just give cover for more buildup of infrastructure and supply lines for naval
Yeah, I think
operations.
it's kind of. I think Matt, you were the one to say this. at least to me, about kind of the Monroe Doctrine, right? Of just kind of looking at this hemisphere in the U.S. saying this is our zone, and as you start to put all the puzzle pieces together, it starts to really paint that picture of, this is further examples of the U.S. trying to lock down our hemisphere essentially.
Yep, exactly. You look at prior episodes in history, big naval exercises, weather does tend to play a big role. We can go back, look at
Right.
Spanish Armada. We can look at a lot of them. Weather is a big factor. Think if you're positioning this exercise, US controls the escalatory ladder here. Like we control the time and place. And I think the choice to do this in hurricane season, um, is probably a reason for that, right? You want to use weather to
Right.
your advantage.
Absolutely. Great. Well, I think that's a good place
All
to
right.
stop for today. Thanks again, Matt, for going deep on these three topics. We'll see everybody here for next week's episode. And as always, make sure you like, subscribe. We're on YouTube, LinkedIn, X as well. So again, thank you for everybody for watching. See you next week.